Our podcast sponsor today is strategytraining.com. If you want to strengthen your strategy skills, you can get the overall approach used in well-managed strategy studies. It's a free download, and you can go to firmsconsulting.com/overall approach. That's firmsconsulting with an S.com/overall approach. And if you're looking to advance your career and need to update your resume, you can get a McKinsey and BCG winning resume template as a free download at www.firmsconsulting.com/resume PDF. That's www.firmsconsulting.com/resume PDF. Hey, Ilya, welcome to the show. It's good to have you here.
Hello, thank you for having me.
Well, it's an exciting time with everything that's happening in AI and all the money being funneled into AI through venture capital firms. So I suppose you're the right person to be speaking to this week. So I'm going to start off by paraphrasing a common question I get with new VC principals we work with, right? So we have a lot of clients who have come through the ranks and they've taken leadership roles in VC funds. So one of the things we've been grappling with is, where does the skill with the top performing VC funds lie? Is it in the selection of whom to invest in, or is it in the way they manage the investment after they make the investment, or is it equal on both sides?
That is a great question, Michael. And I've spent 20 years at Stanford studying this very question.
Very good. You're going to summarize 20 years of work for our audience.
I'll try to do it in 1 minute. Even
1 minute. Okay, let's do it.
It might not be in one sentence. But the summary is, on the one hand, there is no one simple factor that determines whether venture capitalists are going to be successful or not. So if somebody is looking for a golden egg, that's kind of, I have disappointing news. At the same time, yes, there are principles, factors that VCs use, smart VCs, that enable them to be more successful. And my research, my work clearly shows that. And I think it is so important. It is so important not just for VCs, but for all of us, that I have a name for it. I named it the venture mindset. And it is really an approach to how you go about and make decisions. And it holds for both selection. It in fact starts even before selection.
Yes.
How you organize your pipeline of deals, of potential deals. Then it holds for selection. Then it holds for your negotiations with the startup founders. And then it also holds for how you operate after you invest. So in fact, the venture mindset is something that is first critically important. Smart VCs, successful VCs all have it. And I also think that this is something very counterintuitive that most people outside of the VC don't really completely follow. So let me now give you one example, if I may, about what I mean by the venture mindset.
Yes, please.
I hope that hopefully I will surprise at least some of you, of our listeners, Michael, today. So here is, at least I surprise my Stanford students when I teach a venture capital class, and every single time I surprise them with many things. And here's one. What is the one single most important question that VCs ask when they, for the first time, see any investment opportunity? Like, you go around the world and you see many startups, and what is the first question? What is the most important question? Okay. And when I ask this question, people, or my students, they will say, well, what do I think about the founder? Or do I like the idea? Or what is the business model? In fact, it's none of this. It's none of this. The venture mindset asks the following question: why I do not want to invest in this startup? And that sounds very counterintuitive.
Yes.
Venture capitalists, you are supposed to make investments, right? But the very first question you ask is, why do I not want to invest in this startup? And then, if you find out at least one what I call red flags.
Yes.
Critical flaws. Then VCs will say, oh gosh, I do not want to invest in this startup. And then they will move on. And then they'll consider other opportunities. And asking these red flag critical flaw questions is this one of the specific mechanisms that venture capitalists use. And that is very ingrained in the venture mindset. But when I work with large global companies, for example, they don't ask those questions.
No.
They in
look
fact
for the
go
reasons
into,
why they should do it.
but that's right. They go into this deep analysis of cash flows, the strategies,
Yeah, that's
tactics, the culture. You see the tables, presentations, Excel files flying around. VCs don't do it, at least in the initial step, never. They ask this one question. And amazingly enough, I think that all of us, all of our listeners should be asking this question in their personal life as well. So why, like, let's say, for example, you're looking for a job, okay? And you have a lot of job opportunities. You're trying to get interviews. The very first question to ask when somebody offers you to go through an interview or to submit your application, why do I not want this job? As opposed to, oh, why do I want this job?
Yes.
It turns out to be this is a much more healthier and more successful question to ask. So, Michael, are you surprised?
I am surprised, but logically it makes sense because I used to be a corporate strategy partner previously. And I remember that in most companies, in fact, in every company I've seen this, when we present a recommendation, and even if the client themselves is presenting something, they'll do a lot of analysis of why they should do it. And then the last 5% of the work is allocated to the risks, which is why they shouldn't do it.
Right.
But with the venture capital mindset, you're skipping that first 95% and starting with the end 5%, which is what is the most important risk that will stop you from going ahead with it, which is what you call the red flag. Is that correct?
That is right. Absolutely. Even though I don't think VCs skip the step. You see, what is really interesting is that it is an inversion.
It's an inversion,
It means
yes.
that they start by asking the question, why do I not want to invest? And then, of course, if your startup, Michael, passes their red flags, then they in fact will change the tack.
Yes.
And for about 1 out of 10 startups, okay, that pass through their initial red flag approach. And by the way, when I say 1 out of 10, it's like not a random number.
Yes.
Taken out of thin air. That's kind of based on my research. When we started thousands of venture capitalists and a lot of investments. So for those 1 out of 10 startups, they change the tack, and now they go kind of back in your example, and then they ask the questions, oh, why do I want to invest? Why do I want to invest? Or really, as one of my VC friends told me, the way he loves asking this question is, why am I really greedy to invest? So they change the tack. So they don't skip.
Yes. I mean, you think I used the word a little bit incorrectly there. What I meant is they invert it, as you pointed out.
Right. Correct. Absolutely correct.
This seems to be very efficient to me because why do all the work of deciding whether you should do it if in the last 10% of your time you identify a red flag? It's better to identify the red flag first, and only if it passes the red flag test, then you do the other work. That seems incredibly efficient to me.
I completely agree. Completely.
So now so the best VCs in the world use this approach. I'm guessing that all of them do this.
Most of them, everybody who follows this venture mindset is doing that.
Yes, because they all know each other. They've come through the same firms. They've been trained by each other. It's the same way in strategy consulting. We all have our approach of doing it because we all know each other. In the VC space, they have a different way of doing it, and it's largely based on the model you just showed me.
It's an interesting question, whether they learn from each other. I think if you come to a venture capital firm as a junior partner, then you definitely learn from the way your senior partners, your senior colleagues work.
Yes.
I think that the reality is that it is, if you're a VC, it is difficult to learn in between the firms, so to say. There are no, you cannot go to kind of a simple VC academy where you're going to learn all of this.
So this is a kind of an apprenticeship model, like similar in strategy consulting, where you watch what a senior partner does, you learn it, and then you pass it to the people below you.
It is. It is in many ways. It is also, I think, a world where those who acquire this venture mindset, not because you're smarter, but because just you have to survive.
Yes.
And succeed in this unforgivable environment of investing in startups, investing in disruption, then I think that those that adopt venture mindset relatively quickly, they survive and succeed. And those that don't, they do not. They just disappear, they lose. And I think the same as happens in any disruptive environment that we now see around the world, in global companies and industries, but I think also in our personal life. Those who are more flexible and who can adopt the venture mindset, those are just much more likely to become successful. And I think that is really the major reason why my co-author, my former student, Alex, and I wrote the venture mindset, which is not just, for top decision makers, but really for everybody who would like to survive and succeed in the quickly changing environment.
You've said something that's really fascinating. I want to pull that thread. And I'm going to constantly contrast this with corporate strategy work because I think the audience has a sense of how that works, especially our audience. So if you look at management consulting, corporate strategy, business unit strategy, and so on, a lot of the times we're working with very successful companies who want to have even greater success, right?
Correct.
There are times when we work with companies going through a dramatic transformation because their business model has just collapsed. But that's pretty rare, actually. The most of the work we do is for successful companies trying to be more successful. You talked about the fact that they use this red flag approach because it's a means of survival. If they don't use this approach, they don't get to survive because it's a very, I don't want to say cutthroat, but it's a very competitive industry. Is that correct?
It is a very competitive industry. Absolutely. Very much so.
So then they're not using this approach to be smart or to show a creative framework. It's because it is the best way for them to survive.
It is. It might be the only way, apart from just being lucky. But you can be lucky only once. It's unlikely that you win a jackpot in the lottery again and again.
I mean, that's the whole reason you have these diversified portfolios, because you know most is going to fail, right?
It's very interesting because the moment you mentioned, Michael, diversified portfolio,
yeah,
that raises a red flag for me. And here's why. At the end of the day, when I came to Stanford, I became a professor of finance.
Yes.
And in the world of finance, when you say diversification, that means, we need to spread, buy thousands of stocks, invest in, the entire NASDAQ, S&P 500, Russell 3000, or whatnot, right?
But that's not diversification, right?
So well, that is diversification, but that is not the diversification that VCs are using. They're using what I call a smart diversification. Their diversification is much closer to Warren Buffett's diversification. If you look at Warren Buffett's portfolio, it is diversified. He does not invest in 1 or 2 or 3 stocks. He typically invests in like 40 to 50 stocks. But it is a meaningful diversification because there is a non-trivial positions in a limited number of stocks. It is the same with VCs. Typical VC fund will invest maybe in 20 to 30 to 50 deals. So 20 to 50 startups.
Yes.
It is a diversification, right? And they expect most of the startups, in fact, to fail.
Yes.
But it is a meaningful diversification, which means that you learn a lot about each startup. You actually make decisions on each startup. And you don't invest in thousands of startups. You invest in a relatively limited number of startups, and you hope that 5 out of those 50 that you invested in, or 3 out of 30, will be really successful.
Yes, I agree with you on that. And for the audience that's listening in, you use the example of most people, the non-smart diversification is spreading it across the S&P 500. But even that's not proper diversification, because you mentioned some of the reasons where you don't take a meaningful position, you don't really understand the businesses you're investing in, but also you're concentrated on American stocks with the American exchange rate, American currency, American inflation, rather than spreading that across, isn't it?
Correct. So, if you go to your financial advisor, to a good financial advisor, then likely good financial advisors say, well, you have to invest also in bonds, not only in domestic stocks.
Yes.
And you also need to invest in international equity. not just domestic equity, and so on and so on. And that is all a good idea. But that means diversification, investing in many portfolios. Like for the listeners, go to your, let's say you have a pension plan.
Yes.
Go into your pension plan and maybe you invested in Vanguard or Fidelity mutual funds. Well, check how many stocks are there, whether it's domestic or global. Well, there's going to be maybe hundreds, if not thousands. So that is what in finance we mean by diversification. And when I say diversification in the venture capital context, in the context of the venture mindset,
yes,
that in fact is a different type of diversification.
Yeah, absolutely. It's almost a sense that you're taking meaningful positions, but you're investing where you have an understanding, as opposed to the common investor who's sitting at home, may not have an understanding of a company or a sector, but everyone's talking about it, so they go in to get diversification. Is that a good way of paraphrasing it?
It is. It's interesting because venture capitalists, those that practice venture mindset. So first of all, they don't spread too much.
Yes.
They spread but in a limited.
They're concentrated in a sense.
They're diversified but concentrated. Absolutely. Yes. Okay. A second is, yes, they do not invest just because they hear somebody say, "Oh, that's a great startup. Let's invest."
Yes.
Right. Well, and trust me, Michael, if you hear about any startup on TV, that means that it's too late for you to invest if you're a venture capitalist.
Yes, absolutely.
They would like to be the first. And they do use other venture mindset principles and mechanisms to be the first. But they go in, they do spend a lot of time. Do you know that my research shows that on every single startup that early stage venture capitalists invest, on average, they spend like 200 hours of due diligence.
Well, sounds like my kind of guys.
Yeah. And well, it's a lot of time. It's a lot of effort. And trust me, when my Stanford students come to me and say, I would like to be venture capitalist because it's kind of, glitzy, fashionable. Most of this work actually is very boring. Okay. Is very down to earth. You're doing due diligence. You are checking on your existing startups and your investment portfolio. But yes, it's a lot of effort. But it's a lot of, as you correctly pointed, it's a lot of concentrated effort, but with smart diversification. And without diversification, it is not going to work because the failure rate is very high. That is kind of the critical feature of any disruptive environment. And again, venture capitalists just experienced this for 50 years. But I think most of us are now in the industries where we're experiencing this more frequently and more frequently. Let me tell you one story. I have a close friend who lives in Switzerland.
Yes.
He's a relatively wealthy gentleman, and he's not from the world of venture capital, but he's my friend. So he knows that Ilya is an expert, is a Stanford professor, expert in venture capital. So we got together, and he told me, Ilya, you know what? Your kind of venture capital stuff is all rubbish. I mean, here's a different word, okay? Much more impolite.
Yes.
It's all rubbish, he said. And I said, why? And he said, well, you see, I met these guys, and very interesting startup. And I invested in this startup. And you know what? I lost all my money because those guys went belly up. Okay, so that was the story. And I asked him, so how many startups did you meet, or how many founders did you meet before you decided to invest? And he said, oh, just those, just that one startup.
Well, there's a problem, right?
But that's the first problem, which is it's 1 out of 1. No.
Yes.
Do you know that VCs on average meet 100 startups? Actually more, 101, my research shows on average, to invest in just one. 1 out of 101. They say no 100 times to say yes only once. So my friend, first mistake he did, 1 out of 1. Well, the second question I asked, so how much time did you spend doing any kind of due diligence on what they did? And he said, well, I liked them. I thought they were cool. The idea looked cool, so I invested. And of course, this is all rubbish. And I said, well, that was rubbish. But the rubbish, I said, was not the guys that you invested in. It's not the startup. It is your process.
Absolutely.
It's one out of one, and you spent maybe 20 minutes on due diligence. Okay, no, and then I told them a little, being a professor, a little lecture about how he might have improved his outcome.
I want to go back to something you said earlier, which is very fascinating, and I want to put it into context for the listeners, right? Because obviously you have an amazing background and you've been studying this for 20 years, and I have a strategy background, so I have some sense of these things. But I think for the general listener who wants to apply these principles, some of the numbers need to be put in context for them. So they gave the number of 200 hours researching a company once it's past the red flag stage. It sounds like a lot, but I remember once we were trying to figure out why IT projects are so badly implemented in the world of business and government and so on. And we found a country that had rolled out a ID system that was being used to pay pensions and so on in Europe. And we went to meet them to find out, how do they do this when every other client we're working with tells us that they're running 5 years behind, 10 years behind, and the budgets are going up by 300%, 400%, and so on. And they took us through their process, and they told us it took them 3 years to plan the rollout of the IT system, 3 years of planning, and it took them 13 months to roll it out. And the reason they could do it in 13 months is because their planning was so thorough. And for them, they said that 3 years sounds like a lot, but if you add a cost to that versus the cost of the overall project, the 3 years is actually a rounding error because the rollout of the entire IT system cost something like 4 billion euros, but the planning only costs them 20 million euros. And I think the point I want to make here is that 200 hours sounds like a lot, but when you compare it to the investment you're going to make and the time you're going to commit, it's basically a rounding error, isn't it?
That's a very interesting point, Michael. Also fascinating. There are a couple of points here. The first one is, well, everything in our life is relative.
Yes.
So, yes, for $1 billion or for €1 billion project, spending 200 hours might seem insignificant. But of course, VCs don't invest $1 billion in a startup typically every day.
That's true.
Right? So they invest in startups at a stage where there is not that much financial information. Sometimes there's no prototype. So they have relatively limited information. So in fact, you have to try hard to find enough materials, so to say, to spend 200 hours on. So in fact, that's a lot of time, especially because venture capital firms are relatively small. It's not that you have 10,000 people working for you doing all this analysis, planning and analysis. As a result of that, you also, of course, do the due diligence on those startups that you decided not to invest, right? At the end of the day. And there are a majority of them. So you're spending a lot of time also on stuff that, well, and will end up not materializing. But once you mention the strategy and planning for a large company, this tells me something else, which is when we studied the venture mindset, we in fact, amazingly enough, spent a lot of time looking not at venture capitalists, but at large companies.
Yes.
In fact, half of our book, for example, is about large companies, not about venture capitalists. And one of the reasons why large companies spend 3 years trying to do planning, it's not because I think of the routing error. It's because the traditional mindset in the large company is all structured about what I call a take it or leave it decision, which means that either we decide to go with this project and commit 1 billion euros, or we decide that this is not a good project, and therefore we will not commit 1 billion euros. And then we can spend 3 years kind of thinking about this and planning and spending 20 million euros.
Yeah.
That is a typical traditional mindset. And it's inefficient. It does not work well in most situations, and it cannot be further away from the venture mindset. So let me tell you another story, okay? When venture capitalists invest in startups, they never ever commit to see that startup through to its eventual outcome.
But I want you to repeat that just so everyone gets it.
Yeah.
You're saying they never commit to seeing it through to whatever the endpoint is.
Exactly. And you know what? Thank you for asking me to repeat, Michael, because when I talk to people about this, even to my students at Stanford, before they fully comprehend this, it's like their mouths open wide. Why? So let me repeat and then explain why. Okay. So when venture capitalists invest in a startup, they never say to a startup founder, here's the money. And by the way, we know that you need more money because you will scale, you will grow. We commit to see your project through. If it requires 50 million, we'll pay 50 million. If it requires 100 million, we'll pay 100 million. They never commit. There's never commitment.
Yes.
That's very important because typically the startups raise what we call a lot of funding rounds. So they raise money once, and then on average, 15 months later, they will go again, and they will go again. Do you know that a successful startup, like for example, a unicorn, I'm sure our listeners know what unicorns are. My research shows a successful unicorn on average raises over 6.5, so 6.5 rounds of venture funding. So they are very greedy for funding. And the venture capitalists that invested initially will decide again later in 15 months whether they want to invest again or they do not want to invest again. So there is no commitment. As a result of that, what's happening is what you are going to spend 200 hours on is on the initial investment. And then 15
therefore,
months
it's a significant amount of time. 200 hours for an initial investment.
It's for the initial investment, right?
That's round one, basically, right?
That's round one. And then, of course, what's going to happen is that 15 months later, let's say, okay, the startup needs another round of funding. First, the venture capitalists now will know more about the startup because there is a progress. Some milestones reached, others have not been reached. We know much more about the team, about the clients, about the product, about the business, and so on. So there's more information. And as a result of that, there will be another round of due diligence. Do we want to invest? Do we want to continue investing in the startup? And the venture capitalists will get together and decide again. So in fact, of course, they will know a lot of things already. So they will use the information they get in the initial round. But it's kind of another round of due diligence. And this will continue every single time. Yeah. Every single round. Now, going back to your example of a large company installing IT, typically, large companies don't think this way.
No, I've not seen that. I've seen a few do it that way, but it's not common.
So what they do is the following. There's a lot of fight, okay, for the budget allocation. But once you have this for your project, then I think the approval in the future is much easier because the company already committed to a project. So I think that large companies in the spectrum between flexibility and commitment, I think large companies that follow the traditional mindset are typically much more on the commitment side. And the venture capitalists, but also the most innovative companies of the world, they're much more flexible. They're much more flexible. Like if you look at, let me just give you one example. If you look at Amazon is flexible. They close projects all the time. They close projects that are not successful. So what would be a good example of a project that we know about? Of course, many projects are, private to companies. So have you heard about Fire Phone that Amazon developed like several years ago?
Yeah, in fact, I actually even spoke to the Amazon executives on that very topic about how they closed it and why it was considered a success when they did that. But let's hear it from your side.
Fantastic. Well, it's fantastic. So maybe if that was on a podcast, I think your listeners should go back and listen to this again, because I think that learning from this is critically important. Notice that not only Amazon executives closed it, but also that they considered it a success. Now,
Yes.
success on many levels, but one level, they had the flexibility, they had the venture mindset to close this project relatively quickly. And they behaved like venture capitalists, which is they funded this project, they funded it again, and then they looked at its performance and decided, well, you know what, it has not reached our milestones, and therefore we're going to close it. And it is an amazing success, Michael,
Yes.
for a large company. And trust me, my research shows that traditional companies with traditional mindset have great difficulty in doing this. There's a special name for this in the annals of business research.
Yes.
Of the traditional mindset it's called the escalation of commitment.
Yes.
And I think that it's a huge problem for VCs, for venture capitalists, because if you think about this, okay, so you're a venture capitalist, Michael, and I'm a startup founder, so you invested in me, okay? Well, you're going to be on my board. You will see me once a week. Maybe we'll be getting emails from me every day. We'll become friends. And a year down the road, I'll tell you, Michael, you know what? I need $5 more million. And you know that startup is not going well. But you will have a psychological feeling
Yes.
that you kind of need to double down. Well, no. In fact, I think it's very important to find out when to quit.
The sort of sunk cost mentality. Yeah.
That's the sunk cost mentality. And, you know, I observed it so frequently. In fact, when we do this corporate strategic sessions with large executives at global companies, we very often administer what I call a decision-making survey, where executives fill the survey about how they would make decision in various situations. And then we discuss this, their results. And by the way, the reason I ask them to do it, because if I just tell them that, you know what, that's what Michael did, okay, they would believe that you did it, but they would not believe that they would do it.
Yes.
Because of
Yes,
course
absolutely.
yeah, because they think, oh, of course Michael would do it. Oh, of course Ilya would do it. But you know what? We are smart enough. We would
We are
never.
smarter, yes.
So I always administer this survey, and one
Yeah.
question I always ask them about this escalation of commitment, and it's like a little game, and they always get into the trap. So in a traditional organization, if you think about like 100 top executives, 50 to 70% of them will decide to continue on a project that they started maybe a year or 2 years ago that is obviously not a good project and just need to be shut down. And then we'll spend an hour when I reveal the results talking about how the venture mindset can help. But you see, Michael, just telling people, oh, that is the escalation of commitment, you have to do something about it, kind of is not very helpful, because it's actually difficult.
Yeah.
It's actually difficult if you're like the CEO of a large company. And so what we came up with in the venture mindset is specific mechanisms. Let me just give you one mechanism.
Yes, please.
That venture capitalists use, and that I believe traditional organizations that would like to survive and succeed in the current environment need to adopt. So they will become a little bit closer to the venture mindset. So as I already mentioned, let's go back to our example. As I already mentioned, you, Michael, is an investor, you're a venture capitalist, and you're investing in my startup. So you are what we call the lead partner. Or in a large organization, you're going to be like a manager, an executive in charge of the project. And then the next round comes, and you would like to invest again. Well, the concern is the escalation of commitment, or as you correctly pointed out, the sunk cost, okay? What happens is that venture capital partnerships typically would say, no, we would need to meet again. And it's not you Michael, who is the closest to Ilya, who is the closest to the founder who's going to make decision, but all of us.
Yes.
And all of us, meaning like 5, 6, or 7 partners, they're further away from me. They are not members of my board. They do not exchange emails from me every day. In fact, they might have seen me 5 times, okay, in their life. And they can look at the next round of funding in a much more objective way.
Yes.
And they can veto it down. So it's kind of asking the audience, so to say, okay, or asking a friend. There's a game, there's a TV game that maybe some of our listeners know quite well. That is the TV game where you have to. It's Do you want to be a millionaire? Have you ever seen the?
Yes, absolutely.
Right, and so in this game, you want to see a millionaire, you can call a friend. And one of the reasons to call a friend is to you think you know the answer, but you're not sure, right?
Yes.
And so you call a friend. And it's interesting that research suggests that friends are typically right. Like there's a very large fraction of because friends are cool at this point, they're not in the heat of the moment. It's the same with venture capitalists.
Yeah.
They're playing this game. Do you want to be a millionaire? What? Maybe in their case, they play the game. Do you want to be a billionaire?
Yeah.
But there are this venture capitalists, they're partners who are like friends. And your Michael as a partner will come and call them kind of. Now, large organizations just don't use it typically. But if you want to resolve the escalation of commitment, we describe just in detail, step by step, how you can do it, how you can implement it. And one way to organize, calling a friend, and I'm with my fingers right now, doing the quotes, like quote, call your friend within organization, unquote. For example, in order for a project to proceed or to see where the project reached milestones, you will ask executives from other business units.
Yes.
Or you will get some external consultants.
That's the principle of how a board of directors should work in the first place, isn't it?
Absolutely.
That's why it was conceived to have independent people that are not operationally involved. They don't have a relationship and an emotional attachment to a product or business unit leader to come in and objectively look at the data.
Absolutely, Michael. But let me say something else, which I think is also important. I don't want I don't want this to be lost, because the entire concept of the venture mindset is that you make decisions differently the first time you see a project and when you re-evaluate it again. What I observed with the board of directors and overall with the traditional mindset is that there is a process. It could be bureaucratic, inefficient, but there is a process. But the process is that you spend a lot of time thinking about the project first time. This is your example about planning, okay, for 3 years.
Yeah.
And once this is done, you kind of don't want to look at it.
Yes.
That's the escalation of commitment.
That's a big difference. Yeah. That's actually a critical difference.
That is a critical difference, because the venture mindset, again, is exactly the opposite. Amazingly enough, despite the fact that we discussed 200 hours, you in fact spend less time when you decide to invest initially. But then you use additional mechanisms, additional, I would say, kind of safety locks when you decide whether to continue investing, continue supporting the project. And I do believe, first of all, I believe that this traditional mindset can learn from the venture mindset, but also I believe that you really have to give executives specific mechanisms. And kind of mechanism, I mean, what, this is what you need to do. So here's the truth, Michael. Every single organization is unique.
Yes.
And I can describe you many mechanisms as we do in the book, but every single large organization, the CEO, the chairman, the owner, the board, they will have to implement it in their own way. And so when we come to specific organizations, there are a lot of subtleties, but the generic mechanism is there. And again, I studied so many venture capital firms. Trust me, they're all behaving differently. They're all a little bit different, but the principles are all the same.
You've actually made a very, very important point, but you haven't said it, but you've explained the concept. I'm going to pull it out for the audience because it's so important. It reminds me of a conversation I had with Stephen Schwartzman, head of Blackstone. And he was talking about what he considers to be the worst trade or deal he ever made. And he tells a story about how the head of a fund flew him to the fund's owner's yacht and started screaming at him for like a good 30 minutes. And he said the mistake that he made, Stephen Schwartzman, is that he was championing a deal when he shouldn't have been championing a deal, but he should have set up a structure whereby when a deal's made, there's no champion, but everyone on the approval committee, the investment committee, as they call it, needs to agree to it. It seems like you have the same structure here whereby everyone has to agree and there's no champion. Is that correct?
That is a great point, Michael. Thank you for bringing this up. And that is what I call consensus.
Yes.
And in the traditional mindset, consensus is a very dangerous thing. And again, it kind of sounds counterintuitive, no? Like we sit around the table.
Yeah.
And we feel comfortable when everybody agrees with the course of action that we decided to take. We think that consensus is a good thing. And sometimes there's a consensus, but in fact, there's no champion, even in large organization. Yeah. There's no anybody who is truly, truly enthusiastic, but at the same time, there's consensus. Yeah, it's an okay deal. I think we should proceed. The venture mindset is exactly the opposite. The venture mindset is all about finding deals where there is no consensus. In fact, we call it agree to disagree. Isn't it cool?
I love it.
So that in the crystal clear implementation of the venture mindset, you in fact do not proceed if everybody thinks it's a great deal, because then it seems, oh, something is off. I think we missed something. I talked to one legendary venture capitalist at some point, and that venture capitalist told me, he's been in the business for 40 plus years. And he told me, every single great deal that we made, so every single great startup we invested in, there was a lot of disagreement. And some people were really opposed. And every single time where we all agreed it was a great deal, every single time it was a dud. It was a bad investment.
Yeah.
And there's a reason behind that, Michael. And the reason is that if you're a venture capitalist and you invest in startups, the future is uncertain, right? And if all of us agree, that means that likely we're like trying to find consensus by not really projecting the uncertain future, by not really understanding what's going to happen. We're kind of applying our linear existing thinking.
Yes.
But what we really should be doing is applying our exponential thinking. And so many venture capital firms with a venture mindset, they say, you know what? You can have 2 partners out of 7 that agree on the deal. Like if there's one champion, there must be one champion who is extremely enthusiastic. But if she could convince another partner, just 1 out of 7 or out of 6 remaining, then it's a good deal. You know what? Let's go. For the first time, when we have to invest again, that's a different story, right? Yes. But for the first time when we invest, we'll say, you know what, you just need to convince one partner. There are other firms that they get together, they argue a lot, and then the champion should make a decision themselves. Think about this. Like there's no voting, and there's no need to reach consensus. So VCs try to avoid consensus as much as possible. And of course, in the traditional mindset, it's all about trying to reach consensus, which means that I think large organizations that follow this strategy, they really miss on most disruption, on most innovative projects. despite the fact that they have internal resources for those fantastic internal projects. There's one example I have. You mentioned about IT in your wonderful example earlier on, Michael. So I'm sure that all of us know a firm, Mattel.
Yes.
The toy. I'm
Mhm.
sure we will use them, okay, either for
Yes.
ourselves or for our kids, for grandchildren. And so um, under the previous leadership, okay, it took so long for them to decide how to redesign the website. They needed to redesign the website. It took so long to reach a consensus. There were hundreds of PowerPoint slides, and they needed to reach consensus on everything.
They're just compromising and compromising.
Yeah, by the time they reached consensus, okay, I actually think the platform changed or whatever, so the design anyway was already outdated. So I think that reaching consensus, on the one hand, you can see why it's important sometimes politically
Sometimes.
within an organization, but specifically when you face an uncertain future, when you face a new green space, when you face a disruption, I think you would like to follow a very different strategy, agree to disagree. And again, this is the principle this is one of the 9 principles that the venture mindset follows. But again, it's easy for me to say so, right? Agree to disagree, Michael, with your
Yeah.
colleague. But again, it's all about specific mechanisms.
Yes.
You need to follow very specific mechanisms that you ensure that you don't have consensus when you don't need to.
So I'm a big military guy, and I like the phrase agree to disagree, but I would use maybe a different phrase where I would say diversity in counsel, unity in command. So we agree to disagree, but then the full backing of the firm goes behind this once a decision is made.
It's very interesting, Michael. Okay, well, once you said you're a big military guy, let me give you a military example. How
Let's
about
do it.
it? Let's do it. I love military history.
Yeah.
I think I'm more of a history guy than a military guy, but military strategy and military tactics are fascinating. And again, I think the smartest generals used a lot of the venture mindset. Okay, I guess
Yeah.
subconsciously so. But let me give an example about a strategy in the military context. So all of us have heard about the Cuban Missile Crisis in
Yes.
the early 1960s. Okay, what I think not everybody knows is that during the height of the crisis, President John F. Kennedy used this principle about agree to disagree in a very specific way. And he insisted that everybody spoke as equals in his team's deliberations. I mean, he was the president. He could veto anybody, okay?
Yes.
But then he insisted that there would be no chairman, neither him nor anybody else, and that there would be no rank, because his idea was to ensure that everybody speaks their mind. Everybody delivers as much information as possible. And there was a room full of very smart people. But do you know what he also did? Which I thought, when I read about it, I thought, wow, that is the pure implementation of the venture mindset, is that he decided to skip some important meetings.
Mm.
He just went out of the office, out of the Oval Office. And why? Because he felt that his presence might, I guess, intimidate is the right word, intimidate his team.
From sharing
But
their mind.
they wanted them. He wanted them to share information without any intimidation. So he, in fact, left. And you actually can read. I read the transcripts of very, very heated exchanges during those dangerous days of the Cuban Missile Crisis
Yes.
in the Oval Office, and it's amazing because I just wondered whether this very, very seemingly very small but very intentional action on President Kennedy's part really, was important in avoiding a nuclear disaster. So one principle of agree to disagree for large leaders, I think, is what? You have to think about how in certain circumstances you need to limit your power. And
Yes.
this is just one of examples that speaks to the agree to disagree principle of the venture mindset.
It seems like such a small thing, but it's the small mechanism that leads to an outsized outcome, right?
This is really important, Michael. I'm really glad you mentioned this because, when I was a young professor at Stanford, like I guess many young people, I wanted to change the world. And I thought that the way to change the world is by doing something big.
Yes.
Big impact.
Yeah.
Okay. You do something and you get Nobel Prize, and this is huge. Okay. The reality is, I think, is that it is small things that make at the end of the day a larger impact. And this is what if you ask me what is my biggest learning of this 20 years, and I've learned quite a bit, I think one of the biggest learnings is the power of small intentional things. And again, when we go to the venture mindset, it's not about, there are a lot of big things there, okay? Sure. But at the end of the day, it's small things you change that in your speaking kind of formal language, in your decision-making process, that sometimes seem like small, but can lead to dramatically different outcomes. So I'm a great believer in small intentional things. When I say intentional, that means that you actually intentionally follow this mechanism because you realize what you want to achieve.
Yes. I do want to make one other point, and I am conscious of time here because I've been booked into something else. Otherwise, I could end up speaking to you for hours, if not days.
Well, invite me back, Michael.
I actually made a note on my diary to invite you back so we can keep the conversation going because I think it's fascinating. But I want to make one point. This is a point I'm going to build on in the next conversation, is that it sounds to me that when a venture capital firm makes an investment with the 200 hours of research for the round one funding, then they make a decision again whether they want to be in round 2 or round 3 or round 4. They're almost treating their participation as a financial option. They have the right, but not the obligation. Is that a good way of thinking about it?
It's a good point. So it is contractually legally true. Most of the time they will have the right, but not the obligation to invest. Of course, there is also such a thing, Michael, as reputation.
Yes.
And reputation is important. So you know what? If, Michael, you invested in my startup, okay? And then you said, well, Ilya, I love you, but I decide not to invest again. Well, I will be unhappy.
Yeah, you would be offended.
But
that's a great analogy, by the way.
Right. But if you do it with every single Ilya that you invest in, okay, with every single founder, then you will acquire a reputation of not supporting your founders.
Yes.
And so you have to choose. Yes, you will not invest in fact, maybe most of your founders, but you definitely will invest in some of them. And that is, in fact, a decision that every single venture capital firm has to make. How many founders they support. And amazingly enough, many venture capital firms reached out to me now as they've grown, as their organization changed, as they getting new partners. Many of them will say, Ilya, can you come in? And I just spent some time recently with a large firm and discuss how to think about this kind of what they call portfolio allocation and reinvestment decisions. And it is a non-trivial question.
I think it's a good point to wrap up part 1 here, and then we're going to do a part 2 later. How does that sound?
Absolutely. Well, thank you so much, Michael. It's been a pleasure.
I enjoyed the conversation so much. In fact, I was trying to move my other meeting, but I can't move it. So let's do this. We'll put a pin in it, and I'll write to your team, and we'll set up something for your latest availability, and we'll do part 2.
Fantastic. Thank you, Michael. And I hope to get a lot of comments from your audience as well.
I think it's an amazing conversation.
I always love hearing comments and what people think and questions. So I look forward to continued conversation.
Fantastic. Thank you so much, Ilya. We'll be in touch. I really enjoyed it. It's been an amazing conversation. I look forward to following up with you on this.
Absolutely. Thank you, Michael.
Take care. Ciao. As we wrap up, today's podcast is sponsored by strategytraining.com. If you want to strengthen your strategy skills, you can get the overall approach used in well-managed strategy studies as a free download. Go to firmsconsulting.com/overall approach. And if you're looking to advance your career and need to update your resume, you can get a McKinsey and BCG winning resume template example as a free download at www.firmsconsulting.com/resume PDF.